You're glued to the charts, your stomach churning with every dip and spike. You keep telling yourself, this is the path to financial freedom. But let's be honest, the stress is burning you out. You check the price first thing in the morning, last thing at night, and probably a few times in between. Every green candle is a shot of adrenaline. Every red one, a wave of pure panic. Is this really investing? Or is it just high-stakes gambling with your mental health? But what if I told you the real secret to multiplying your crypto isn't about perfectly timing the market? What if the most proven, low-stress strategy has consistently beaten the vast majority of those so-called expert traders? What if you could build real, life-changing wealth in crypto without the anxiety, without the screen addiction, and without the emotional roller coaster? In this video, I'm going to share the holding secret that will not only grow your wealth, but also give you back your peace of mind. We're going to tear down the myth of the genius day trader and build a blueprint for patient, powerful, and profitable crypto investing. So if you're ready to get off the hamster wheel, stop trading. Do this instead. Before we dive into the strategy that completely changed my approach to crypto, let me quickly introduce myself and tell you why this is so personal. My name is your name, and like a lot of you, I didn't start out as a calm, cool, and collected investor. Not even close. When I first jumped into crypto, I was a classic trader. I was completely hooked. I had charts on multiple screens, I was in a dozen different trading groups, and I was convinced I could outsmart the market. I'd string together a few small wins and feel like a genius, but then I'd get completely wiped out by a sudden crash or a bad leveraged trade, losing all my gains and then some. The stress was unreal. It wrecked my sleep, it strained my relationships, and it just sucked the happiness out of my life. I was chasing fast money, but all I got was chronic anxiety and a portfolio that was going nowhere. It was a painful, expensive education, and it forced me to realize one critical thing. I was playing a game that was rigged against me. That's when I finally took a step back and started studying what actually works. Not the flashy stuff, not the get-rich-quick promises, but what the data shows has consistently built wealth over time. And the answer was overwhelmingly clear, yet almost insultingly simple. This video is everything I learned on that journey. It's the guide I wish someone had given me when I started. It's designed to save you the time, the money, and the mental anguish I went through. And right up front, I am not a financial advisor. This is not financial advice. The crypto market is wildly volatile and carries massive risk. My goal is just to share my experience and the research I've found to help you make more informed decisions. You always have to do your own research and figure out what's right for you. My only agenda is to show you a path that I truly believe is more sustainable, more profitable, and infinitely less stressful than the one I started on. So let's start by pulling back the curtain on the world of active trading and exposing why, for most of us, it's a trap. If you've ever tried day trading crypto, you know the pull. The promise is intoxicating. Make money from anywhere. Be your own boss and turn a small stake into a fortune. It's a powerful story, but for the vast majority, it's a dangerous illusion. Let's break down why the trading life is a losing game for almost everyone. Part 1, the brutal statistical reality. First things first, let's look at the cold, hard numbers. The crypto world is filled with influencers showing off their wins, but they never show you their losses. This is called survivorship bias, and it's extreme. We see the one person who hit a 100x jackpot, not the 99 others who lost everything trying to do the same. So what does the data actually say? While studies in the unregulated crypto world are tricky, data from traditional markets and new crypto research paint a grim picture. A famous study on Brazilian futures day traders found that a shocking 97% of them lost money over 300 days. Only 1.1% earned more than the minimum wage. Let that sink in. These people dedicated their time and money, and nearly all of them would have been better off flipping burgers. More recent crypto analyses echo this. A paper from the Bank for International Settlements, BIS, looked at data from 95 countries between 2015 and 2022 and found that 73% to 81% of retail investors in Bitcoin lost money. That means, best case, only about 1 in 4 people made a profit, and that's just for general investors. For active traders trying to time the market, the numbers are even worse. Most experts estimate that only 10 to 20% of active traders ever become consistently profitable. In fact, some sources say 80% of day traders quit within 2 years, and after 5 years, only 7% are left. Why? The market isn't a magic money printer. For every winner in a short-term trade, someone else has to lose. It's a zero-sum game, or once you add in fees, a negative-sum game. And who are you playing against? You're up against billion-dollar hedge funds, high-frequency trading bots executing thousands of trades a second, and insiders with information you'll never have. These whales use the hype created by retail traders as their exit strategy. As a retail trader, you are a tiny fish in a tank full of sharks. The odds aren't just stacked against you. They're crushingly, statistically, overwhelmingly against you. Part 2, the psychological warfare. If the stats don't scare you, let's talk about the psychological toll, the part you never see in the Lambo memes. Active trading isn't a battle of wits. It's psychological warfare you wage against yourself. It all starts with FOMO, the fear of missing out. You see a coin pump 50% in an hour, and an alarm goes off in your head. You feel this magnetic pull to jump in, terrified of missing the next rocket to the moon. So you abandon your strategy and buy near the top, right as the early investors are taking profits. Then the price dumps, and a new feeling takes over. FUD, fear, uncertainty, and doubt. Panic sets in. You sell for a loss, only to watch the price bounce back a few days later. This cycle of buying high on greed and selling low on fear is the #1 destroyer of wealth in financial markets. Trading is a relentless emotional roller coaster. The high from a win creates a dopamine rush that feels amazing and can be as addictive as gambling. This leads to overconfidence, making you take bigger and bigger risks. But the lows are crushing. A losing streak can trigger crippling anxiety and depression. Many traders then fall for revenge trading, making huge impulsive bets to win back what they lost, which almost always ends in disaster. This isn't just in your head, it's physical. Studies have linked crypto trading to serious psychological distress, including higher rates of anxiety and depression. Traders report terrible sleep and constant stress. The need to always be watching the market means you're never really off. You're checking your phone at dinner, in bed, at work. It hurts your relationships, your health, and your overall quality of life. Is the tiny chance of profit really worth all that? For most people, the answer is a hard no. Part 3, the hidden costs that bleed you dry. But let's say you're one of the rare few who can handle the stress and actually make a good trade now and then. The system is still set up to bleed you dry with 1,000 tiny cuts. First, transaction fees. Every time you buy or sell, the exchange takes its slice. If you're trading often, these fees pile up fast and eat directly into any potential profit. Second, there's slippage. In a fast-moving market, the price you click to buy at isn't always the price you get. That tiny difference might seem like nothing, but over dozens of trades, it adds up to serious hidden losses. Then comes the biggest hidden cost, taxes. This is the one most new traders completely forget. While tax laws are different everywhere, most places make a huge distinction between short-term and long-term capital gains. When you buy and sell crypto within a short time, usually under a year, any profit is a short-term capital gain. This is often taxed at your normal income tax rate, which can be painfully high. But if you buy and hold an asset for more than a year, your profit is a long-term capital gain, which is taxed at a much, much lower rate. Think about it. You make $50,000 from a year of stressful trading. As short-term gains, you could easily owe $15,000 or more in taxes. But if you made that same $50,000 by holding an asset for over a year, your tax bill might be half that or even zero, depending on your income. So, frequent trading not only ramps up your stress, it also maximizes your tax bill. Part 4. The illusion of control. The final part of the trap is the illusion of control. Many new traders stumble upon technical analysis, TA, reading charts, finding patterns, and using indicators like RSI or MACD. TA feels empowering, like you've discovered a secret language that predicts the market. Here's my harsh truth. For most retail traders, it's basically astrology for finance. While pros use it as one of many tools, beginners treat it like a crystal ball. They see a death cross and panic sell, or a golden cross and FOMO in. But these signals are just probabilities based on past data, and they fail all the time. In fact, study after study has shown that strategies based on common technical indicators do not produce better returns than a simple buy and hold strategy. The market is a chaotic system driven by news, regulations, social media hype, and a few massive players. Believing you can predict its short-term moves with a few lines on a chart is pure hubris. You don't control the market controls you. When you add it all up, the terrible odds, the psychological damage, the hidden fees, and the false promise of TA, the conclusion is clear. Active trading is a rigged game. But if that's the problem, what's the solution? It's time to talk about the antidote. Okay, now that we've stared into the abyss of active trading, let's talk about the strategy that stands in complete opposition to it. It's a strategy that favors patience over panic, discipline over impulse, and a long-term vision over short-term gratification. It's known in the crypto community by a simple 4-letter word that started as a typo in a 2013 forum post, but became a powerful investment philosophy. HODL. HODL, now lovingly called hold on for dear life, is the simple idea of buying a cryptocurrency and holding it for the long run, no matter what the price does. It's not about timing the market, it's about time in the market. It's a complete mindset shift from a frantic trader to a patient investor. The trader is a hunter, chasing every small movement, always on edge, burning energy. The hodler is a farmer. They carefully pick their seeds, assets, plant them in good soil, a secure portfolio, and patiently wait through the seasons, market cycles, letting them grow into something real. They don't freak out at the first storm or harvest their crops too early. They trust the process. This isn't just a cute philosophy. It's backed by a mountain of historical evidence. For almost everyone, holding has proven to be not only less stressful, but way more profitable than trading. Let's look at the numbers. If you had bought Bitcoin in early 2019, when it was around $4,000, and just held on, you would have seen it hit an all-time high of over $100,000. From 2015 to 2025, Bitcoin's compound annual growth rate has been in the range of 28 to 35%. Dramatically outperforming traditional assets like the S&P 500. Compare that to the wild, unpredictable returns of trading. Sure, some traders might get a 200% gain in a bull run, but those are outliers. For every one of them, there are dozens who lost everything. Holding, on the other hand, gives you a clear path to capturing the overall growth of the crypto market. The HODL strategy works because it ties your success to the long-term adoption and growth of the network, not your ability to guess what will happen in the next 5 minutes. It lets you sidestep the psychological traps of FOMO and FUD. When the price crashes, you're not panicking. You're either unfazed or you see it as a fire sale. It minimizes your transaction fees, and best of all, it qualifies your profits for the much friendlier long-term capital gains tax rate. In short, holding transforms crypto's biggest perceived weakness, its volatility, into your greatest strength. It lets you ride out the storms and cash in on the long-term compounding growth that has created life-changing wealth for so many patient investors. It's simple, powerful, and it works. So you're probably thinking, okay, holding sounds great, but how do I actually do it? That's what we're going to build, step by step, right now. All right, this is where it gets real. We are going to build your entire long-term holding strategy from the ground up. No complex formulas, no risky moves. Just a simple, repeatable, 3-step blueprint. Think of it like building a house. First, we pour a strong foundation. Second, we build the structure with quality materials. And third, we secure it. Step 1, laying the foundation. The power of dollar cost averaging, DCA. The single most powerful tool for a long-term investor is dollar cost averaging, or DCA. If you only remember one thing from this video, make it this. So, what is DCA? It's simple. You invest a fixed amount of money into an asset at a regular schedule, no matter the price. So instead of dumping $1,200 in all at once, you'd invest $100 every week for a year. Why is this so powerful for a volatile asset like Bitcoin? 2 massive reasons. First, it takes all emotion out of buying. The decision is already made. It's Tuesday, you buy $100 of Bitcoin. You no longer have to torture yourself asking, is the price too high? Should I wait for a dip? What if it runs up without me? All that mental noise that leads to bad decisions just disappears. Your only job is to be consistent. Second, it automatically averages your purchase price. When Bitcoin's price is high, your $100 buys a little less. But when the price is low, when everyone else is panicking, your $100 buys you way more Bitcoin. Over time, this guarantees you buy more of the asset when it's cheap and less when it's expensive. It's the perfect antidote to the risk of going all in at a market top. The historical data for DCA is incredible. For instance, a strategy of investing $30 a day from 2016 to early 2025 would have turned a total investment of about $98,000 into a portfolio worth well over $1 million. This is how you make volatility your friend, not your enemy. Most major exchanges let you set up recurring buys, so you can automate the whole process. Set it, forget it, and let consistency do the hard work for you. This is your foundation. Step 2, building the structure, choosing your core assets. Now that our foundation is set, what do we build with? The crypto market has over 20,000 different coins, and the brutal truth is that most of them are garbage, scams, or destined to fail. Trying to find the next Bitcoin is a fool's game. A smart long-term investor focuses on quality, established assets with proven track records. This is why I'm a huge fan of a simple, concentrated portfolio, especially for beginners. A great model is the 80-20 rule. Put 80% of your portfolio into the blue chips of crypto, and if you have a high risk tolerance, you can use the other 20% for more speculative bets. The 80% core, Bitcoin and Ethereum. Your core holdings, the absolute bedrock of your crypto portfolio, should be in the 2 most dominant, secure, and widely adopted cryptocurrencies, Bitcoin, BTC, and Ethereum. Bitcoin, BTC, the digital gold. Think of Bitcoin as your long-term savings, a digital store of value. Its main job is to be a secure, decentralized, and scarce asset that can't be censored or inflated away. With a fixed supply of only 21 million coins, it's earned the nickname digital gold. Recent data from late 2025 shows that around 61% of all Bitcoin hasn't moved in over a year, highlighting a strong culture of long-term holding. Bitcoin is the anchor of your portfolio. Ethereum Dash, the world computer. If Bitcoin is digital gold, Ethereum is the decentralized internet. It's not just money, it's a global platform for running decentralized apps, dApps. The entire world of decentralized finance, DeFi, and NFTs is mostly built on Ethereum. While Bitcoin leads in certain metrics, like the number of unique addresses, Ethereum's ecosystem is buzzing with more developer activity and on-chain transactions related to dApps. With its move to proof of stake, you can also stake your ETH to help secure the network and earn a yield, almost like a dividend. By putting the majority of your capital, say 40% in Bitcoin and 40% in Ethereum, you're building a rock-solid core. You get exposure to both the top store of value and the leading smart contract platform. It's the safest, most reliable way to capture the overall growth of the crypto industry. The 20% speculative bag, optional. This part is only for those who can stomach more risk. This is where you can explore other projects, but you must go into it with the full understanding that this money could go to zero. When you look at altcoins, don't just chase whatever is pumping. Be a detective. Look for projects with a real use case. Does this thing actually do something useful? A proven team. Are the developers public and credible, or are they anonymous ghosts? Solid tokenomics. Is the supply capped like Bitcoin, or can they print it forever? Do insiders hold most of it ready to dump on you? A real community. Are people actually using and building on it? Even with great research, treat this 20% like venture capital. It's for high risk, high reward shots. Never ever put money into altcoins that you can't afford to lose. Your BTC and ETH are your path to wealth. This is your lottery ticket. Step 3, securing your future, the wallet strategy. This last step is absolutely non-negotiable. It doesn't matter how much your crypto grows if you lose it all to a hack or an exchange bankruptcy. You have to take control of your own assets. This is summed up in the most important rule in all of crypto. Not your keys, not your coins. When you buy crypto on an exchange like Coinbase, they hold it for you. You are trusting them. While major exchanges have good security, they are giant targets for hackers. And as we saw with FTX, if the exchange goes bust, your money can disappear forever. To truly own your crypto, you need to move it into a wallet where you control the private keys. There are two main types. Hot wallets. These are software wallets on your phone or computer, like MetaMask. They're fine for small amounts you might use, but they're connected to the internet and are vulnerable. Cold wallets, your personal Fort Knox. This is where the vast majority of your holdings must live. A cold wallet or hardware wallet is a physical device, like a ledger or Trezor, that keeps your private keys completely offline. Since the keys never touch the internet, they are virtually impossible to hack remotely. Your strategy is simple. Use the exchange to buy your crypto with your DCA plan. Then, on a regular schedule, say once a month, withdraw that crypto from the exchange to your secure cold wallet. When you set up your wallet, you'll get a seed phrase, usually 12 or 24 words. This phrase is your money. It's the master key to all your crypto. If you lose your hardware device, you can use this phrase to get all your funds back. But if someone else finds this phrase, they can steal everything and there is no one to call for help. You must secure this phrase offline. Do not save it on your computer, in an email, or as a photo on your phone. Write it down on paper, or better yet, stamp it into metal and store it somewhere safe. Make multiple copies and put them in different secure locations. This 3-step process, DCA as your foundation, a core of BTC and ETH as your structure, and self-custody in a cold wallet as your security, is the full blueprint. It's the low-stress, methodical way to build real wealth in crypto. Following the 3 steps is the easy part. The hardest part is psychological. It's about having the discipline to stick with the plan when every emotion you have is screaming at you to do the opposite. Let's tackle the biggest fears that will test you. What do I do when the market crashes 50%? First, know that this is going to happen. It's a question of when, not if. Extreme volatility is a feature of crypto, not a bug. Bitcoin has had multiple 70 to 80% crashes in its history, and every single time it has come back to hit a new all-time high. While there have been periods of record low volatility, you must be prepared for these drawdowns. When a crash happens, a trader sees a disaster. A long-term holder with a DCA plan sees a sale. A 50% drop is a massive buying opportunity. Your fixed dollar amount now buys you twice as much Bitcoin. These are the moments when future millionaires are made. Instead of panicking, you should feel calm knowing your system was built for this. Your mantra in a bear market is, the time to buy is when there's blood in the streets. Zoom out on the price chart. The crashes of 2018 and 2020 look like tiny blicks now. Today's crash will look the same in the future. Trust the data and stick to your plan. But I'm missing out on all these 100x altcoin pumps. That's just FOMO whispering in your ear. For every memcoin millionaire story you hear, there are thousands you don't hear about, people who lost their life savings chasing those same pumps. Remind yourself of your strategy. Your 80% core of Bitcoin and Ethereum is your get-rich-for-sure plan, if you're patient. That optional 20% is your get-rich-quick lottery ticket, which you fully expect could go to zero. If you are always chasing what's hot, you will always be late. You'll just be providing the exit liquidity for the early investors. Real wealth isn't built by jumping from one hype train to the next. It's built by finding quality assets and holding them for the long haul. Let other people gamble. You're an investor. How long do I actually have to hold? When do I sell? This is a personal question, but a good way to think is in market cycles. Bitcoin's market cycle, often influenced by the halving event, has historically been about 4 years long. But it's not a perfect clock. Recent cycles have shown that timing and returns can vary. A minimum hold should probably be one full cycle, so 4 to 5 years. This gives you time to ride out a bear market and see the next bull run. Ideally, you're thinking even longer, a decade or more. The goal isn't to perfectly sell the top. That's just market timing in disguise. A smarter approach is to have a rebalancing plan. For example, if after a huge bull run, your crypto has become an oversized part of your net worth, you might sell a small percentage, say 10 to 20%, to take some risk off the table. But the real HODL mindset is that you might never sell your core position. As Bitcoin and Ethereum become more integrated into the financial system, you might be able to borrow against your assets instead of selling, avoiding taxes altogether. You're shifting from a mindset of when do I sell for dollars to how do I grow this new asset for generations. Mastering this mindset is the final piece of the puzzle. It means detaching your emotions from the daily price and having unwavering faith in your long-term data-backed strategy. If this is all clicking for you, if you're feeling a sense of relief that there's a better way than being chained to the charts, then do me one small favor and hit that subscribe button and turn on notifications. I put a ton of work into these deep dive guides, and by subscribing, you won't miss any future videos designed to help you navigate crypto with confidence. And I've got a question for you. What has been your single biggest psychological struggle in crypto? Is it FOMO? Panic selling? The stress of trading? Drop your experience in the comments below. Reading through the community's shared stories is one of the best ways for all of us to learn we're not alone. Let's bring it all home. We started with the picture of the stressed out trader, a slave to the charts, losing a battle against their own emotions and a rigged system. We've torn down the reasons why that path is a dead end for almost everyone. The brutal stats, the psychological torment, and the hidden costs. But more importantly, we've built a powerful alternative, a calm, disciplined, and proven path to building wealth in crypto. A path that doesn't require you to be a trading genius or sacrifice your mental health. It's a simple 3-part blueprint. Foundation. Use dollar cost averaging to automate your buying and turn volatility into your friend. Structure. Build your portfolio around a strong 80% core of Bitcoin and Ethereum. Security. Secure your future by taking self-custody of your assets in a cold wallet, so you truly own them. This strategy is about so much more than just money. It's about getting your time, your energy, and your peace of mind back. It's about changing your relationship with investing from one based on anxiety to one based on patience and abundance. Financial freedom isn't just about a number in an account. It's about the freedom to live your life without being chained to a screen. Building real wealth is a marathon, not a sprint. The HODL philosophy is your training plan. It's not the sexiest strategy, and it won't get you rich by next Tuesday. But it is the most reliable, time-tested way to capture the incredible potential of this technological revolution. Thanks for investing your time with me today. I hope this gave you some clarity and confidence for your own journey. Stay patient, stay disciplined, and I'll see you in the next video.